Inflation, I have to say, apart from geopolitics, is really the talk of the town. I mean, the number of people I overhear in the corridor saying, will the Fed cut, will the ECB cut? I mean, you tempered quite a lot of expectations in saying, look, it's too early to cry victory against inflation.
Yes, it's too early to cry victory, but when you looked at what monetary policy achieved in the last 12 months, let's say, we can be rather confident. Remember, 1 year ago, the fear here in Davos was that we would have inflation and recession, and we will possibly escape both. So far, we achieved a soft landing with disinflation and a slowing down on activity, but without recession. And there won't be a recession in France or in the euro area this year. So this is why I say that our next move will be a rate cut.
Yeah.
It will, barring a major surprise or shock, happen this year. But then comes the question of the calendar, which is probably not the most interesting one. Will it happen?
It's pretty interesting, Governor.
No, I know it's a question here in town, in Davos, and will it be in spring, in summer, in fall? This question is open. But may I say why it's not the most relevant one? Because we are not calendar-driven, Francine, we are data-driven. If you allow me this image, monetary policy is a bit as of a tennis match rather than a soccer one. What do I mean? There is no fixed timing in a tennis match, but there are sets and steps to win. And this is what we are on tracks. Probably a more interesting question is what kind of data do we need to cut rates? Again, we are data-driven.
So because you're data-driven, do you think a cut will have to happen at a time where you actually have new forecasts, or there's some data points?
Perhaps one word about the data we would like to have, or we will look at. We must have the inflation outlook anchored around 2%. I would add solidly and durably. And here I can be somewhat more specific. Solidly means that we look at effective data, including core inflation and including wages. And durably means that we look also at forecasted data, and yes, our forecast, not only our forecast, but also inflation expectations. So this is the outlook we look at, and again, expect very probably a rate cut this year, but the question of the season is a premature one.
But when are you expecting inflation to give you hope that actually it's a downward trend and that it's really, I guess, expectations are anchored to the downside?
I would say that we shouldn't show obstinacy, but also not show haste. What do I mean? About obstinacy, and this is your question, there is this last mile or last kilometer theory, saying that it will be harder to get disinflation in this last kilometer. As we are in Europe, we say kilometer. I don't think so. I don't think so. When you look at the evolution of CPI so far, it has been more or less symmetric. It went upwards very quickly, but it went downwards swiftly. So I don't think the last kilometer will be more difficult by nature, and so monetary policy should not be more rigid in this last kilometer. So no obstinacy, but also no haste. We should be patient enough. And I would say I am at once confident and patient. I'm not complacent. No, this is very important, but this is the right mix of confidence and patience. We are more confident than 1 year ago. Obviously, our monetary policy has achieved much already, but we should remain patient. If not, we could miss the target.
But so this governor gives me the sense that you would do one cut and then want to wait and see where we go after that. Could we only see one cut this year?
No, let us see. Again, it will be data-driven, and this is reasonable. Yeah. We cannot be in a situation where we give a fixed calendar in advance. This would be, by the way, Francine, this would be the comeback of forward guidance, and in a very uncertain world, it's not the right way to proceed.
Is it possible to actually break down why inflation is coming down? So how much of it is thanks to the monetary policy of the ECB and other central banks?
I like your question, because this is a proof we are on the right track. And so we are successful in disinflation, but this question starts to come to say, were we lucky or were we talented?
Yeah. And the answer is?
I would say in our case, euro free facts, hard facts, in favor of monetary policy. So there was an element of luck. But if you look first at core inflation, luck means disinflation in energy prices. But if you look at core inflation, excluding energy and food, it decreased significantly from 5.7%, this was a peak in the URL last spring, to 3.4% in December. So this is also due to monetary policy. Second, probably our main achievement this time was to anchor inflation expectations rather close to 2%. It's a major difference with the 70s, for example. And it's not by chance. It's due to central banks' independence and inflation targeting, which has been extremely efficient. Central banks' credibility has been really tested in this episode and strengthened. And if I can add a third element, I think that this last kilometer or last mile shouldn't be of a different nature.
Governor, what worries you the most, given the geopolitics, that a sudden spike in energy would actually mean that you can't cut? I mean, there's so many of these polycrises that we're watching. What would need to happen for you not to cut at all this year?
I said bearing major surprises or shocks, and we live in a very uncertain world where they can be shocks, and we lived through them in the last 4 years. Obviously, the Middle East is our first focus of attention at present. If I can add another element, this year, 24, will be a very political year in most of advanced economy, with European election in June, the US election in November, an important election elsewhere. So we will look at this geopolitical risk, but you cannot you cannot jump to the conclusion. Again, we must be very pragmatic. I don't like this categorization in doves and hoax. I'm a pragmatic, a pragmatist.
So you say, jumping ahead of conclusions, which frankly is what the markets have done when it comes to interest rate cuts this year. Does it make your job more difficult for the transmission mechanism?
I said we are not calendar-driven, we are not market-driven either. We incorporate market expectations through the assessment of financial conditions. And they have been quite volatile, if you look at last fall, on long-term interest rates, with a strong increase till October and then a significant decrease. So I will not qualify market expectations at present.
But you must look at them.
We are probably a bit more patient.
Okay, so they're getting it wrong.
I wouldn't say it this way, but the volatility of market expectations is much more significant than our long-term view. It's our role, in this very short-termist and volatile and uncertain world to bring some continuity and some patience.
Again, if you look at the Governing Council, there's quite a split on whether wage bargaining is going to be a huge deal for inflation. Are you expecting it to?
As I said, when we look at data, it will be about actual data and about forecast. Among actual data, wages play a significant role. It's not mostly the case in France, by the way, where wage negotiations are showing a deceleration of the nominal increase, and we will have a real increase of wages, which will help consumption and growth, but we think we are on the right way. In other countries, wage increase can be more significant, and it plays a significant role for services inflation. But again, the trend is labor market which are less tight, and so it can belong to our confidence. But we will look.